The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
And welcome back to this second sneak preview episode of Volatility Views, live here from the sunny Boca Raton resort here in sunny Boca Raton, Florida. And we are doing this live this week, so live to tape. So by the croquet side, you could say, by the croquet courts here. And I am joined, as always, by my partner in crime, Don Schlesinger from VolX. Don, how are you doing this sunny morning?
Just great. Nice to be here, get away from some of the snow in New York, although I must say that most of it's melted now, and I expect that when we get home, we're going to see temperatures that are pretty close to what we've got here. So it's been a lovely break. We've met a lot of great people, and nice to be with you once again.
Now, correct me if I'm wrong, but this is your first Boca.
Yes, it is. I'm here with our colleagues Bob Kraus and Charlie Barwis. They're veterans of the conference, but although I've been to quite a few in my days at Morgan Stanley, more on the security side, this, of course, being the futures industry, this is my first time down here, and it's a great experience.
Yeah, I've been to quite a few Bocas now, too. I've lost count of which ones, but listeners, for just to fill you in, if you want to know what goes on down here at Boca, all the backroom wheeling and dealing in the derivatives world, it all occurs here in the Magic Bar in the Boca Resort between midnight and 3 p.m. Isn't that where VolX was born?
Well, there's a lot of cocktail parties going on, and I'm sure a few secret deals along the way.
A few too many. I think I was out to a few too many cocktail parties yesterday, all in the name of good business. Now, obviously, Don and I have not been glued to our trading screens all week. We've been busy schmoozing and occasionally playing croquet down here in Boca. So we haven't really been watching the skew and some of the vol and some of the various products. So we're not going to start off this preview show with a full, in-depth volatility review like we will in future shows, but we can do a bit of an overview. Not surprisingly, it has been a crazy week for vol, of course, with all of the devastation going on in Japan and in that region. Not surprisingly, we've seen a bump across the board for the most part in volatility. We saw VIX cash hovering around a low of below 20 actually Monday, I believe it was, and then of course it shot up to a high of over 31 on Wednesday, just off the news of the impending meltdowns in Japan and all the subsequent destruction and chaos that's ensuing over there. And of course we haven't seen the end of that. I'm sure there's quite a bit of weekend risk. We always throw around the term weekend risk, but with the potential for potential nuclear meltdowns, there's significant weekend risk this week. So I'm sure we haven't seen the end of the spikes out there in the vol. I know we've discussed on some of our other programs how the downside skew in the SPX and the corresponding upside in VIX have really been very firm in recent months, indicating that even when vol was coming off and VIX was coming off, that there was still a lot of concern about downside and potential tail risk out there. And so we're seeing the same thing, not surprisingly, right now.
I have to tell you a story about that, Mark. The skew was born, if you will, and I'm sure your listeners are aware. It wasn't always there. Perhaps they're not aware. And so prior to the 1987 October crash, we had what people still refer to this day as the smile, the volatility smile. Well, unless you've got something wrong, a smile is usually symmetrical with a little upturn in the corner of your mouth on each side, but kind of flat in the middle. And if you looked at what people are now accustomed to calling the skew, that is to say the implied volatility of options at a particular strike price over a wide range of prices, both below and above the current spot level or current level of whatever market you're studying, at least in the equity markets, it was fairly flat for the longest of time. Options were introduced a good 15 years prior to 1987, and that's the way they traded. And then, as I like to say when I do some of my lectures and my conferences, in one single day, that October 19th, 1987, the smile was wiped off the face of options, perhaps forever. But I didn't know that it was forever at the time. And so a few months after, I think it was probably January of 1988, I was lecturing at an options industry council affair. I think we were out in Arizona somewhere. And here I was examining this brand new phenomenon, the skew, the fact that below the market options traded at higher implied volatilities than above the market options. And we no longer had this symmetrical smile, but we had this upper left to lower right, downward sloping type of smirk or skew, if you will. And as I was lecturing, I said to the people, you know, there's an opportunity here. There's an advantage. You could do put spreads. If you're afraid of the downside, you could buy a put at one higher strike and at a certain implied volatility, and now all of a sudden you could sell the lower strike, but it's at a higher volatility. So you're still paying for this put spread. There's still a debit, but it's not as much as it would have been prior to the crash, because now you're selling this farther out of the money put at a higher implied volatility. And I kind of said, get it while you can, because this sale's not going to last too much longer. You know, everything will come back the way it used to be. Well, here we are, Mark. How many years? 24 years later. And that skew is just as robust and just as steep, and of course it moves around a little bit, as it was on the day that I said, this isn't going to last very long. So
famous last words.
As long as you're going to be wrong, you may as well be wrong big time.
Spectacularly, exactly. Why not? You know, we have discussed that in some of our initial shows, and it's something we probably should address again, because it is an interesting topic. I think a lot of newcomers to the options market just see skew and they just accept it as fact and assume that it has always been there, when in fact it is, like you said, it's an implied phenomenon. It was born out of the chaos of the 87 crash, and as a result we have all of this field of research and field of study on how options actually perform in those types of scenarios. And so yeah, that is an interesting point to definitely bring up, that it was not always thus. Skew was born from the wreckage of 87.
And of course, again, just another quick digression. What happened, as you probably know as well, is people were engaged in what was called at the time portfolio insurance. They were actually kind of, if you will, sold a bill of goods that you could replicate the protection of a put option contract by dynamically hedging your portfolio, selling futures against it, and continuing to perhaps sell more and more futures as the market would drop, and thereby try to protect the portfolio by trading the correct amount of futures that would have corresponded to the delta of the put option. And then, of course, on that fateful day, we know what happened. The futures kind of dislocated from the cash, and all those sales that you were supposed to have made all the way down, it's like the elevator started at the top floor and went express right to the basement without making any of the stops in between.
There was no opportunity to get off on the way down, no.
So now people were really hurt very badly in some cases by the lack of performance, if you will, of this kind of dynamic hedging. And so it became clear that the only way you could really protect assets under management was to have that put in place before the crash, before the train wreck, not as the car was going over the cliff trying to negotiate your insurance. And so that demand for puts has been everlasting. These below-the-market, out-of-the-money puts have commanded premiums that in some case are many percentage points higher in volatility terms than the at-the-monies. And in order to try to offset some of that cost and pay for some of this protection, people got to selling out-of-the-money calls up above to try to at least indemnify a little bit and get back some of the premium that was spent. And that's what sort of torqued or twisted this smile into the skew that we have today.
Exactly. It's interesting. We talked a little bit about the broad VIX, and people obviously, when they think about volatility these days, a lot of them do think of VIX first, but there are other products out there that are also in the volatility space. And you guys have a particularly, I think, interesting perspective on it right now. You have just listed the VolX vol contracts on the FX options over at the CME. And that's a perspective we don't really hear that often. What's going on currency vol? So what's been happening out there with the currency vol that we're seeing on the vol contracts, and what are people doing out there?
Well, I can tell you something very interesting because we launched our first product, as listeners may know, on the Euro FX, and it was the March contract, but the particular expiration calendar at CME is such that the March contract actually expired on the 4th of March and began trading on the 7th of February. So they call it the March contract because that's the month in which the expiration occurs, but it covered most of the month of February. And we began trading that contract. The first settlement price was $11.55. And believe it or not, that contract actually settled on the 4th of March at $7.80. So there was a drop of 32% in this particular contract. So if I would have put out a headline saying, guess which asset or guess which commodity moved 32% during the month of February? Was it gold? Was it equity? Was it some commodity? The answer was it was a vol contract. And so the 1 month variety of this product is itself extremely volatile. And so we refer to that as the volatility of volatility, because the underlying asset that you're trading is volatility, in this case of the euro, but that itself jumps around and has movement in price. So you'd refer to that as the volatility of volatility. And in this case, in the very first month, here we were with a 32% move. So one of the things that we've seen that's very interesting is that in the 1 month product, across the board, no matter what the underlying asset is, we seem to see very high volatility of the product itself in the 80, 90, sometimes over 100% range. And so we think that this kind of a product could have appeal to the high-frequency traders, the algorithmic traders, speculators, day traders, people who are looking for something that exhibits a great deal of price movement. And, of course, that's not for everybody. And so we have different durations, and we'll have a 3-month product. And the 3-month product that settles to the 3-month realized volatility is a great deal more stable, if you will. It looks a little bit more normal in the 25, 30, 35% range for the volatility of the asset itself, and that may certainly be suitable for hedgers, for people who want to use this as a tool against options positions. So there's kind of something for everybody, and it was interesting to see that very high volatility of the 1 month product in the very first month that we were up and trading.
Yeah, I'm still surprised that there was such a large sell-off in Euro vol. You would think just in some of the corresponding activity that's been going on that it would be at the least a mitigated sell-off, not such a dramatic sell-off. What do you think contributed to such a dramatic drop in Euro vol?
Here's something that's interesting, and this is in part the difference between our product and, let's say, a VIX-like product. If you might have taken a look at something, although the VIX doesn't trade as a listed product on the euro, again, as your listeners probably know, Mark, there's always kind of a markup or a spread between implied volatility and very often what the underlying actually goes on to display in terms of the actual or the realized volatility, which is what we're trading. And historically, over various assets, that spread can be different. I'm more familiar with equities than others, but in equities, it's been very robust at around anywhere from 3 to 5% as that markup or premium. So when the contract first started trading, I think that people who traded the VolX product, the vol contract, began trading it in line with the implied volatility of the euro options, the at-the-money straddles and the puts and calls that were trading. And they exhibit...
Makes sense that was pretty much the existing infrastructure for vol at the time.
That's right. And so they exhibited that premium. But then when the actual volatility was calculated, we do the formula calculation. It's kind of what you see is what you get, rather than the sentiment type of thing. It simply turned out that in this case, the euro volatility itself was not perhaps dropping so dramatically with respect to the actual volatility that it had been displaying all along, but the contract was priced in a manner that reflected those implied volatility sentiments, and the calculation proved otherwise over time.
That's really interesting, because that to me, looking at that and those numbers when I first saw them, I was trying to wrap my head around why there would be such a rapid decrease in the euro vol, and it really it boils down to they were using the old model essentially. They were pricing it the old way, and when you actually look at the realized vol, it requires a little bit more nuance in that. So that seems to more reflect, instead of an actual decrease in euro vol, or an adjustment to what the actual vol actually is.
That's exactly right, Mark. And I think the interesting part is that we intend to, of course, when we first got started, we listed a March contract, and we were up and running right into the realized volatility calculation period right away. But it's our intention, as we roll out other products, to list the actual contract long before that calculation or realized volatility period begins. So we may have a 1-month settlement period, but we may list the contract 3 or 4 months prior to that actual starting to feed the data points into the formula. And we suspect that during that time, which is sort of an anticipatory period, you might see...
shakedown period.
There you go. You might see VIX-like pricing, and you might see some of the implied aspects as people try to sort out exactly where they ought to forecast or predict where that settlement will be. However, there comes a time when you start to pay the piper, when you turn the meter on and the clock is ticking, and now you're actually calculating, because we're going to settle to a real number. We're not going to settle to another forecast. We're not going to settle to an increasing sentiment. We're going to settle to a calculation. And it's at that point that you start to see that when the realized numbers start to come in, people will have to trade the contract in line with the actual development of the volatility that the underlying asset is displaying.
Yeah, I think that's a fascinating development for a lot of our listeners to think about how that actually works. And it is a little bit more insight, I think, too, in exactly how vol actually works, and as opposed to the way it's been done for a long period of time. And I think with that, we're going to close out this segment and roll into our Volatility Perspectives segment.
May I have your attention, please? Quiet, please. It's time for the Volatility Viewpoint.
This is the section of the show where Don and I will usually have a guest or someone else coming in to join our little dialogue. But this week, since we are down here in Boca, it is just Don and I, and of course a few croquet players. And so there's interesting things to talk about in perspective. From the perspective of having been down at this conference, there have been a number of new product announcements down here, and that's kind of what Boca is typically known for. Among the announcements was a slew of new volatility products coming out of SIBO, aimed around the VIX, of course. That is their bread and butter. And it's interesting to see what they're focusing on now, which is they announced back in January benchmarks on the volatility of individual names as opposed to the VIX, which is obviously an index. And they picked some liquid names, Google, Amazon, Apple, a few others. But now they have since announced in the subsequent months actual filings for actual products on these names. And I've gone back and forth with some of the hosts and some of my other shows, and I'd be curious to hear your opinion, Don, about the utility of this type of product and how if you are a sophisticated options trader, it's all there from an implied vol perspective already in the options. But on the flip side, there is, for a lot of retail traders out there and other people who associate that with volatility, there is some utility for that. And obviously I can see why the CBOE is going after it to extend that license. But I'd be curious to hear your perspective on the utility of an implied vol product when we already have on these names, and we already have the implied vol of the names, and then we can talk about some other future products that might be interesting in this area as well.
Yes, surely. I can remember when I was on the trading desk at Morgan Stanley, we did a type of trade that's referred to in the industry as a dispersion trade. And a dispersion trade, for those people not familiar with it, is you take an index, and it might be interesting to take a smaller one that has only 30 names like the Dow, and you say, this is made up of individual names, of course, and they all move in their separate way, and then an index is created. And the dispersion concept is that when you aggregate all of the movement of all of the 30 names, a lot of times the movement can offset. This stock displays volatility, but it does so going up. This stock displays volatility, but it does so going down. And that has a muting effect on the volatility of the entire index, because what happens is you have a lot of offsets. So one stock is very volatile, but to the upside. The other one is very volatile, but to the downside. And you look at the index and you say, well, the index didn't go anywhere at all. It's not so volatile, but a lot has been going on inside the index. So we used to enjoy doing a trade that was called dispersion. We tried to buy the volatility of the individual names and sell the volatility of the index and hope that there'd be enough movement, but in various directions, to collect on the individual names, whereas we were selling the volatility in the index, hoping that it probably wouldn't go anywhere at all, or would not move as radically as the individual names would. The only trouble was that this was 20 some odd years ago, and you couldn't just buy volatility on individual stocks or on indices. You had to create straddles. So we would look at each and every name, look at the puts and the calls, try to buy at the money straddles, manage all of these different positions. And I have to say it was rather accounting intensive and somewhat of a pain in the neck. So the concept of having individual stock volatility contracts is an interesting one from the perspective of being able to do that kind of trading. And I'd like to say I hope that great minds think alike, because we have respect for VIX and for the franchise and the product. But now at VolX, at the Volatility Exchange, it is our intention to bring out not only the vol contracts, which are futures-like instruments and would be regulated by the CFTC, but also what we are referring to as vol shares, also kind of one word put together, for which we have a trademark and a registered name. And the vol shares will permit us to trade the realized volatility of individual stock names and anything that is a security-like. So, for example, we could create vol shares on ETFs, on baskets of stocks, or sectors such as you're seeing now with VIX, simply, once again, giving our spin or our flavor to it in the realized volatility space as opposed to an implied product.
Getting back to the implied stuff just for a few seconds, because you mentioned how you used to do it with straddles, and that is the way it's still done predominantly in the market. So I'm kind of curious, who do you think, who the actual audience market is for another implied vol product when, you know, obviously the sophisticated people are already out there doing it with straddles and with strangles and risk reversals and things like that and vertical spreads. If they want the implied vol of Amazon or Apple, they can go get that now, you know, through the straddles. I am kind of interested in who will actually be taking up these types of products and the necessity for them, because I see the necessity from a branding perspective, from the actual product utility perspective, I'm still a little bit curious as to what the uptake on these actually is going to be.
I can think of a couple of things. In these days, I mean, in my day, not every stock name had listed options. And of course, today there are thousands upon thousands of them. So it's not for lack of having the options, but options trading in order to capture the volatility of an underlying asset isn't always quite as pure as one may make it out to be. And so if you say I'd like to own the volatility of an underlying asset, the traditional way, as you just described, is to go out and do an at-the-money straddle, buy a call, buy a put at a particular strike price that's close to the price of the stock at the moment. You can buy it, you can sell it, either way. But then the process is to capture the volatility or the movement of the underlying. You can't just sit around with your hands in your pocket and watch it for 30 days. You have to manage the position by a process that we call delta neutral hedging. You've got to take a look at your deltas. You've got to try to get neutral. You can trade futures. You can trade stock against it. You can trade more options against it. That becomes somewhat labor intensive. It's somewhat costly because if you're transacting with the options, you've got the bid spread, bid offer spread, you've got transactions costs. But there's another subtlety, and that is as the stock price starts to move away from the strike price of the options, the strike of the straddle, you actually start to lose the optionality. You start to lose the sensitivity to the change in volatility. To take an extreme example, if the strike were 100 and the stock suddenly moved to 150 or to 200, you wouldn't have anything anymore. You'd have one option with a delta of 0, one with a delta of 100%, and that would be the stock all over again, and bye-bye capturing volatility. So what happens
constantly
is
adjust in those scenarios.
What happens is you have to start rolling, and so you move to the strike that's pertinent at the moment. Bottom line is that when you try to capture the volatility by this process, you sometimes do, and sometimes you don't do so well. So tracking it that way is what we call path dependent. It kind of depends on the path that the underlying takes. And so if you actually have a pure volatility product where we simply say, we're going to take the close-to-close volatility intraday, we're going to put it into a formula, and what you see is what you get, and at the end of the period, you've got the volatility. That, of course, is the principle of vol swaps, which, of course, are over-the-counter products. They trade in huge size. They're not transparent. They're not available to everybody. So actually what we've done is we've kind of taken the over-the-counter vol swap market, which is the purest play that you can make in volatility, and we've put it on exchange, transparent, smaller size, accessible and available to everybody.
The counterparty risk or lack thereof.
There you go. He made a point that I should have made and forgot.
a big issue in recent years, as we've seen.
Absolutely correct. It was on my checklist somewhere, but I failed to mention it.
And you're mentioning the realized vol individual names. Is there any sort of time frame? When can our listeners who maybe aren't as into the currencies, but they want to start trading some realized vol, when can our listeners expect some of those to start listing?
Well, I'm hoping sooner rather than later, but we've become very active recently in going out and beating the drums and speaking to.
Hence your booth babe duty here this week. And by the way, I have to say, I thought the mini skirt was a little bit much. Other than that, it was a lovely presentation.
And so we're in talks right now. We've spoken to some exchanges. We continue to speak to investment banks, and the initiative here is to get up and running not only with other products that will be the vol contract and in the futures space, but on the other side to begin to try to roll out the products that would be SEC regulated. And of course, as I said in our last show, anytime you're trying to get a new endeavor such as this up and running, you do have to jump through a number of regulatory hoops, and sometimes these things take a little bit longer than you would have liked.
That will substantially add to the length of time, judging from what we've seen. I think if there's one constant refrain we hear against the SEC in the options space, and there are many, but they're probably the most common and most vitriolic we hear from the exchanges and everyone else in the space, is the glacial speed of new filing and new product approval. And so if that's any indication, we might be waiting some time for the realized of all individual name products.
We're trying to hope that even with Dodd-Franks and with all of the regulatory reform that's proposed, and of course with certain deadlines as to when they're supposed to be implemented, whether that actually happens in July or not remains to be seen. But the point is, the whole concept of having transparency, getting things on exchange, trying to bring some of the products that have been a little bit more obscure out into the public, I think that may bode well for us. I think the environment is right for having these kinds of products exchange traded. And once again, it's our hope to roll out on the indices, perhaps on energy, crude, on rates. It's an ambitious agenda, and we look forward to the coming months and the year ahead. I think we will bring more of these products to the market.
Well, you're right. If there ever was a time that was ripe for volatility and new volatility products, this is obviously it. It's just a question of whether you can get the attention and the resources over at the SEC to get them to move on from their current obsession with Dodd-Frank and Bernie Madoff and all that fun stuff, and actually sit down and approve your product.
Right.
Well, Donnie, I'm glad we had a chance to sit down here together by the lovely croquet courts here in sunny Boca Raton. I'm kind of sad that our next show will be via VoIP again, because this is such a great... We should just do it here every week. What do you say? This will be the new home for Volatility Views.
That sounds good to me.
I'm sure no one would mind. And we'll sit here. Maybe we'll play a little croquet in between our sessions. I'm looking forward to more shows when we'll actually be able to bring on some guests and get into some of the other subjects and do some of the rundowns. But I think for now, these sneak preview shows are great for our listeners to give them a taste, a smidgen of what to expect coming down the road. So, Don, I'm glad you can come on, and anything you want to say to our listeners before we tune out for next time, go ahead.
Pleasure to be here, and once again, just remind people that we have what we feel is a very resourceful website at VolX.us. And so you might want to take a look there. We've brought up a lot of information having to do with the series and indices that we are publishing. So on a great many assets, you'll be able to see a great deal of information. And once again, if you'd like to call in, we have our 800 number at 888-VOLX Corp. The numbers are 888-865-9267. We'd be happy to hear from you.
Call in and ask for Don. He will personally handle your questions.
I also understand that we're now going to start to field some questions in the forum on the Options Insider, and Mark's listeners will be able to call in, either ask questions or simply type them into the bulletin board, the forums, and I'm going to start to hang out there and look at some of your questions, and I'd be delighted to answer them and to chat with you online as well.
Yeah, we're expecting a great surge of user interest and interaction in this show. Obviously, the forum, which will, if it's not live already, will be going live very soon for the VolX, for the Volatility Views program, as well as you've heard in the intro and the outro, we have the voicemail, we have Twitter, twitter.com/options, or twitter.com/VolX_info. That's VOLX, not EX. VOLX_info. You can shoot us emails at questions@theoptionsinsider.com, or what was the email address for? Of course, it's in the outro anyway. So it's
info@VolX.us.
Info@VolX.us. Once again, address it to Don. He will answer your emails personally. Surf into the forums. Head on over to optionsinsider.com/forum. Scroll on down to the Volatility Views section and post away in there. Post us your comments, your questions, your feedback. And again, Don will personally answer every single one of those questions in there. And if they're interesting and relevant, we will discuss them on the show, and you will be immortalized for all of your friends and neighbors. So with that, that's going to close up this second sneak preview of Volatility Views, and we look forward to doing this again next week, and we'll see you again next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VolX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.